Welcome back, fellow idiots. Get it? Wealthy idiots. Welcome back. My name is AJ. Welcome to the Wealthy Idiot Show. If you haven't yet, please like and subscribe. Helps us out tremendously, and we super appreciate it. Keeping with the theme of talking about real estate, I want to cover leverage because that's important in real estate investing. We're going to cover what it is, the risks, how to leverage, and lastly, why to leverage. And hopefully you walk away learning something that will improve your financial future. All right, first let's talk about what leverage is. Merriam-Webster's dictionary defines it as the use of credit to enhance one's speculative capacity. That's it. Thanks for coming. I'll see you guys next time. No, I'm just kidding. In layman's terms, it means you borrow money to invest. That's basically it. It's not much more complex than that. You go to somebody who has money, you tell them you'll pay them interest on that money, and you turn around and you put that into some kind of investment that you hope and pray does better than how much you're paying for that loan. This is a pretty complex concept that many people don't know currently exists. Almost everybody in the top level of the financial world, major companies, Apple, Google, Facebook, major players, Warren Buffett, Grant Cardone, whoever else, I don't know, whoever else is taking advantage of leverage in order to make themselves more wealthy. And understanding why it is they do this and how they're doing it is extremely important. So next I want to talk about the risks of taking out leverage. It's important to remember that borrowing money always carries risks. So if you've been following us recently, you've seen I've been watching these Dave Ramsey videos, and he's been telling people, get out of debt no matter what. So you got this investment property, get out of that debt, stop looking at it, because he looks at everything in terms of risk. And he'll even say, I've tried this before and I failed at it, so it's not good to gamble. And to some extent, he's right. Whenever you're taking out debt, you are taking on the gamble that you're going to have to pay that back somehow. And if your plan doesn't work out and you can't pay that back, you're in some serious amounts of trouble. So doing things intelligently is extremely important. Dave Ramsey didn't do things very intelligently. He took all the risk. All the deals he made with his bank were to take all the risk on himself under the assumption that the real estate market would always go up. And then big surprise, it didn't always go up, which destroyed Dave Ramsey's wealth. He had to file for bankruptcy, and then now he's on this train where all debt is bad and leverage is a no-go for everyone. The second risk of leverage is that it is costly. So if you take out a loan, it's going to cost you to pay it back. In some cases, like mortgages, they've figured out a way to put most of the cost of the mortgage on the front end and then slowly taper off over time. That's called mortgage amortization. And it ends up costing you more money if you sell a house, move into another house, sell a house, move into another house, because you're paying a lot of that cost up front. And it may feel like, okay, this loan is only 3%, 4%, something low, but if you keep moving, they're taking that expenses, the major expenses off of that mortgage up at the beginning. So it pays to actually maintain that mortgage over a longer period of time. And the last is complexity. Anytime you take out leverage, things get more complex. You have more research to do, more numbers to crunch, more things to consider because, like I said, it's a little bit risky. Next on our list is how to leverage. So the simplest way to leverage, and probably the riskiest way to leverage, is called trading on margin. Essentially, you're in an app like Robinhood and you see that margin trading button. So you're like, okay, let's do it. And it says, here's $10,000, go invest it in something and pay us back over time. Well, if your investments don't work out, you're going to have to still pay that back over time. So that's where the risk comes into play. If you don't know what you're doing when it comes to whatever it is you're investing in, it's not a good plan to invest in that because you're taking all that risk on. The next form of leverage is buying a company. You can go to the bank and say, hey, I found this company. I can prove that it's profitable. I've looked at their structure and it looks like a really good deal. I want to buy it. And a lot of times banks will go in with you, like similar to buying a mortgage where you're taking out a loan to purchase an asset. Here you're taking out a loan to purchase an asset, except that it's an actual company. This can be extremely profitable and might be a good idea for a lot of people. If you're really good at business and you really understand how stuff works, you could take out significant amounts of money, put it into this company, and if that company grows over time, it makes it easy to pay that back. So the company itself could pay back the loan, and then you're just getting the appreciation on the growth of that company. And the last is mortgages. So that's the one we're going to talk about here in a minute and how it works. But you buy a house, you take out a mortgage. Banks love giving out mortgages because they are a fairly low risk investment. The house has value, so even if you don't pay your loan back and you file for bankruptcy, there's still a house that contains value, and so they like that. The more risky the investment is for that house, the higher the interest rate's going to go up. So this is where people talk a lot about credit scores being important, making sure that you have a good credit score, you paid off debt before, and you've proven that you can actually pay that debt, you'll get a lower interest rate. And then investing real estate is a higher risk because they look at it as you don't actually live there. So if you're not living there, if you're not your primary residence, your primary focus is going to be on maintaining the place that you currently live, which makes sense. So if I'm living in this house right now, I'm technically renting this, and we'll talk about that another time. And I own houses somewhere else. The bank knows that if I can't pay those, I'm going to keep paying this because I have to keep my family here. So it's a little bit of a higher risk. And what they did is increase the amount of down payment I have to put on it. And that gives them a larger buffer in case they do have to repossess the home. So in most investment properties, you have to put down 25%, and 25% gives them, let's say if they have to sell it for cheaper than the home is worth to get rid of it faster, or the market goes down a little bit, there's a pretty significant buffer there at 25%. Some of my homes I bought for a higher down payment than 25% because, and I've hinted at this before, I don't entirely know what's going on with the housing economy. I covered it before about how I don't like the way stuff is looking. You could check out that video in our channel and take a look at what I think about the real estate market. But because I don't like what it's doing and I want to make sure that we're in a good place, I want to make sure that I'm not over leveraged. I have a good balance of equity against the loans that I have currently out in case something does happen and the economy does kind of take a little bit of a dip there. All right, so last and most important thing on this topic is why to leverage. Two main reasons that you might want to leverage, and the second one is kind of unsuspecting, so stick around for a second. The first is higher investing power. Because you can take, and I'm going to do a little bit of math, you can take out an asset, even if it appreciates a tiny bit, that's magnified against the amount that you put down, not the entire purchase price of the asset. So let's do an example. For $100,000, you buy a house for $100,000. A house appreciates roughly about 4% a year. That's $4,000 for the first year. So we should see that house be worth $104,000 on average. When you bought the house and you put 25% down, let's say, in our example, then you only paid out of your pocket $25,000 for the home, not the full $100,000. So then if you look at that $4,000 gain against $25,000 that you put down, it turns out that's a 16% return that first year. It changes every year after that, but initially it's 16%. So most of the time, like if you were to go buy a home for $100,000, you would get 4% return on your money. If you bought 4 homes, you took out debt for each of them, and you put $25,000 in each, you would get a 16% return on your money. So your total net worth after that first year would be $116,000 as opposed to $104,000. So leverage really gives you that big ability to invest into assets and control assets that are actually worth significantly more. The second main reason why you might want to leverage is tax savings. I know that sounds a little bit weird, but that's what most of these companies and big heavy hitters are actually doing, is that if they take out assets, take out cash from asset and turn around and invest it into something else, that's a taxable event. So if I were to take, let's say I decided that real estate was at the top right now. Don't take me out of context. I don't think that. Let's say I think that real estate's at the top right now, so I want to sell. If I sell it and I turn around and say okay, right now the big play is bonds or the big play is crypto, I have to pay capital gains tax on the sale of that house, which is not great. That could be fairly significant depending on what it is or the time frame in which I purchased that item, and it could be above 20%. In some cases, 20% probably on average. 20% against my money is a huge amount of money. So let's say instead, I'm gonna go, I think the play right now is houses. So instead of taking money out of something like my stocks, paying 20% on the sale out of that taxable event and costing me a lot of money, I'll go and buy this property using the bank's assets. Using leverage, I'll take out a loan and then I'll go buy this property, and that loan will be at like 4, I think right now between 5 and 6%. That's significantly less than the 20%. So if you're on the wealthier side and you're looking at things in terms of how do I reduce my overall cost on all these individual transactions, it may be cheaper, as it turns out, to take out that loan to buy that asset if you think that that's where the play is going to be. And then on the flip side of tax savings, in a lot of cases, like in real estate investing, the interest that you're paying on the loan is a tax write-off. So if you're collecting money, you're paying interest, those two things balance out. You don't actually pay anything to the IRS, but you get to keep collecting this appreciation on this property and building your net worth and building your wealth. So thanks for sticking with us. I know this is a complicated topic. Leverage isn't easy. One of the points we made was that it was complex, but it is a really advantageous way of controlling a significant amount of assets with a lower amount of money to bring your overall gains way up. And the way that we can do it, you and me as regular, wealthy idiots, is through real estate investing is the primary way where we can take advantage of leverage. And if done right, and with the risks understood, real estate investing could be a really powerful tool at growing wealth. Check out thewealthyidiots.com. Make sure that you read some of the articles. We have articles about interest rates recently because they continue to change, and that knowledge is just invaluable when it comes to all of this real estate information that we have to keep track of. So check those out, and until I see you again next time, thank you so much for stopping by.